Now, over to Kenya. The Bankers Association in this country is reporting that a relatively well-intentioned rate capping law has actually ended up with some pretty negative and significant effects. The biggest among them, a suppression of loan uptake. Now, the biggest casualty have been small and medium-sized businesses. In 2016, Kenya put in place rate capping laws that effectively restricted banks to pricing loans at no more than 400 basis points above the central bank rate. Now, KBS report issued today shows that the law has actually failed, spectacularly at that, to achieve its key objective of increasing credit uptake by households and SMEs. It's among a series of surveys from KBA that have shown a consistent trend in adverse effects following the installation of the Banking Amendment Act that was introduced by Parliament and assented to by President Uhuru Kenyatta in the third quarter of 2016.
All these surveys have revealed that the law is not achieving the intended objective of increasing credit uptake where it's needed most. This has been precipitated mainly by tight conditions of lending, which have occasioned a declining rate of private sector credit expansion, dropping to 2% from the 20% rate that existed in 2015. Advocates of the cap would argue that the rate of credit uptake was already on a downward curve anyway. However, we can demonstrate that the Act introduced a distortion which the credit markets have not been able to recover from. Typically, the Kenyan credit market rebound within 3 months of any given shock. But in this case, the rate caps have prolonged it, if not exacerbated the declining trend of credit growth.
So let's dig deeper into that report. Habil Olak is the CEO of the Kenya Bankers Association. He's live in studio with me right now. Thank you for your time.
Thank you.
So let's pedal back a bit, because before the rate caps came into force in 2016 September, even if you roll back all the way to about early 2015, late 2014, we're already starting to see a decline in lending to the private sector. So let's disentangle this too. How much of the decline is attributable to the rate cap, and how much of that happened before the rate cap?
Actually, that's a valid argument, because it's true that there was already a decline in the credit growth by the time the law was passed. And we have tried to do some analysis to sort of like try to disentangle the effect of the rate cap to what was already happening in the market. Mm-hmm. And what normally happens is that whenever there is a shock in the market, it tends to correct itself within 3 months or so. Mm-hmm. And looking at the fact that the rate cap came in at a time when there was already a slowdown, our analysis shows that without the rate cap, the rate should have been, by now, should have corrected by within the third quarter of 2017.
Yes.
So by that time, we were expecting that it should have been something close to about 6% in terms of rate of growth. Given that by then we were achieving something close to about 2%, that could give us an indication of the impact of this capping law.
Because that's around
the difference between
500 basis points or so.
Yeah.
Right. But speaking of credit growth, because looking at the numbers from the central bank, by end January, private sector credit growth, a very meager number, 1.8% in nominal terms. And a lot of the lending categories were actually seeing a decline in lending. Transportation, agriculture, mining, business services, all of those sort of shrinking in the amount of outstanding credit to those sectors. Is that still persisting deep into the second quarter of the year?
Actually, we haven't seen a change in the trend. The trend has more or less been maintained in the below 2% growth in almost all the segments of the credit market. I think to go back to the rates that we were observing before the for example, early 2015, where we were in the range of 15 or so % in terms of growth to the current 2%. I think we are unlikely to see that happening unless the environment completely changes.
Right, because in real terms, if you apply inflation on this, you're looking at a real decline of about 2 percentage points, pretty much.
Absolutely, yeah.
Right, but okay, moving forward though, the budget's coming up in about 4 to 5 weeks. One approach that has been suggested by Treasury is to essentially just put a clause in the finance bill that would repeal the Banking Amendment Act altogether. Is that something you would support?
I think there have been a number of hints from the National Treasury. I think they are working on some law. The Cabinet Secretary has indicated the fact that they are not just looking at the banking sector, but they are looking at the whole credit market. So they are coming up with a law that will look at the whole credit market. The Chief Administrative Secretary also indicated the fact that they are looking at something that will bring in the risk-based pricing. And I think those are developments that we are agreeable to. They are in line with what we have been advocating for, and therefore those proposals are quite agreeable to us. Mm-hmm. They are moving in the right direction, and we think when it finally comes up in the finance bill, it will be something that is worth consideration and for discussion at Parliament.
Right. One last question for you. Speaking of parliamentarians, because these guys rammed through this bill with a lot of fury, a lot of anger. I mean, asking them to turn around and repeal their baby, especially one that garnered them a lot of points to the populace, that's going to require them to lose a lot of face. So let's assume, for argument's sake, that these reforms do not happen. Mm. And we're still dealing with rate caps if we're having this conversation in December this year. Mm. What sort of economic damage are we likely to see by then?
I think one is that what we are seeing currently will most probably continue and even worsen. For example, the distortions in the credit market, where the credit is being directed elsewhere instead of where it should really be directed, that will possibly continue. The challenges that the central bank is having in terms of managing the monetary policy, that's likely to continue because it's occasioned by the law itself. But I think in my view, the biggest impact will be on the government's agenda. Government's agenda currently has been clearly focused on the big four: manufacturing, housing, food security, universal health care. And all of them, the SMEs are playing a significant role. Manufacturing, they are targeting specifically SMEs. The housing, facility, the achievement of that will be premised on the SMEs. Mm-hmm. The food security, similarly, most of food that we produce in Kenya is produced by the smallholder farmers, who are the SMEs. And I think for the government's agenda to succeed, SMEs have got to be facilitated. Mm-hmm. And the critical thing for them is to be able to access credit. Yeah. Now, if the law is not amended and the SMEs continue getting constrained in terms of accessing credit, then the achievement of the government's Big Four agenda, I think, will be quite in doubt.
All right. We'll leave it there for the time being. Thank you very much for your time this evening, sir. We'll be speaking to Habil Olake, the CEO of the Kenya Bankers Association.